Good morning, good afternoon, good evening, traders across the globe, and welcome to the 1981st edition of Short-Term Trading Live with Oscar Carboni. And you know what? I am here to say something very exciting, and you know what that is? The core or the liquidity of our markets is coming back, baby. It is coming back. If you don't know what I'm talking about, you'll find out shortly. What's going to happen in this video, if you will indulge me, is I need you to watch a clip of a previous video I had done a couple of years back. You need to see what's in that video in order to go forward with me in this video. So before we get started, please, fans, do me a favor, indulge me. There's absolute reason for this. It's about liquidity in the markets, the Dodd-Frank rules, and whether or not our market could sustain a down move. So please watch the clip before your eyes. It's coming up right now, and then I'll come out and finish this video. This video is a video that I need to discuss a bunch of topics with. The main topic is going to be this. There's a liquidity issue in our markets, traders. It never really seems to matter when the market goes up. Now, I've done videos in the past, and I've referenced, or I've more than just referenced, I've done videos that were completely geared towards the Dodd-Frank rules, and that some of those rules are actually very good for the banking industry, but some of them are horrible. Now, in my opinion, because the politicians, Donald Trump and his buddies, and I'm a big Trump fan, as you know, but they had a meeting on Friday, and at that meeting was Goldman Sachs' head, and they had the heads of BlackRock and the heads of fantastic major companies that trade in the United States. And he sat around that table, and he discussed Dodd-Frank, which brings me to bring this video to you, because we have to talk about Dodd-Frank. Now, I know that there's no one in Donald Trump's organization that's going to hear from me. Who cares about Oscar Carboni? But you never know if someone in Washington does trade that somehow knows someone who knew somebody else who has a cousin with an uncle who's got a friend that actually watched an Oscar video. And maybe, just maybe, someone has the ear to one of Donald Trump's advisors. I don't think I'm going to get the invite to Washington, although I'm qualified, and I'll tell you in a moment why, to easily have been sitting at that table on Friday to help advise. I've got 1,575 videos. There's more. Actually, I've probably got 2,500 videos. 1,574 of them are out on YouTube. I've got millions and millions of YouTube viewers that have followed me since 2007 in these nightly videos. And I've been calling markets in the fashion like this. 35 years in the business, a lot of it down on the trading floors. I am one of the best, if not the best out there when it comes to technical analysis and how to read a chart and then how to interpret what you've read. I am your man. Now listen, there is proof in this. I stood in front of this camera in 2007 leading into 2008, and I called the top in the S&P, and literally, while we were in a bull market, and thousands of fans know this, they've all been watching since 2007, I called the top of the bull market and where it would stop at, the number 1577. It rallied all the way to 1576 in the S&P and stopped, called, and started to drop. Coming into 2009, in 2008, and I made this call on video for thousands of you, going into 2009, I said the market would crack all the way to 668 in 2009, but I said this in 2008, at the end of 8, it would crack down to in 2009, it would crack to 666, and that would be the bottom. In fact, 668 was my call, 666 was the low. So amazingly, in front of this crowd, I called the top in the stock market and the bottom in the stock market. And believe me, I was just as shocked as the rest of you. But then, forget about calling these markets for my YouTube fans. I'm on television in front of millions of people with Melissa Francis. And crude oil's trading $103. And I called the top in crude. And I said crude would make it down to $45. And that happened. The top of the stock market called. The bottom of the stock market called in front of thousands, in front of millions, the top in crude called. I am an authority when it comes to reading these charts. So that is what I wanted to express upon you. Many of you know this, but I wanted to show you some of my qualifications, and those are only some of the major calls I've made. Is every call right? Of course not. There's no way I could make every call correctly. But if you look at my track record in these videos, you'll note that my long-term calls, they have been right on the money. And these calls we're discussing were my long-term calls. That makes me a little bit of an authority, because who else knew the crude was going to crack? Nobody expected that crack to come in '07, and the bottom, I called the bottom way before it ever got there in 2009, and what price the bottom would be at. Good stuff. Let's move forward. This brings me to today's video. President Trump, please address the rules pertaining to the Dodd-Frank liquidity when reviewing your Dodd-Frank rules. Now, on Friday, he made an announcement, but most people think they've rescinded the rules. That's not going to happen without an act of Congress. He asked for a review of the Dodd-Frank, and of course, in the right spirit, he wants to get rid of some of those rules. But I'm here to say, if no one is talking to you about the liquidity, we've got a liquidity issue. No one notices it in these markets when they go up. When markets start to go down and you've got no liquidity, there is a black hole. What do I mean by that? The Dodd-Frank rules, a portion of the Dodd-Frank rules, and I downloaded over 10,000 pages of that and read through it like a lunatic back when they created those rules. And in that, there was a discussion about the commodities and the stocks and about liquidity and how banks are no longer allowed to trade for themselves and create liquidity. Now, if you don't recognize what liquidity does for a market, we had liquidity in 2007, 8, and 9, and the market dropped as quickly as it did. Imagine no liquidity. With that in mind, I want you to watch this quick clip. I did this clip a year and a half ago on a video to talk about if the market ever started to go down, there is a flaw in the markets because of Dodd-Frank, and I did a quick illustration. I would like for you to take a look at this illustration now. It's very quick, and then I'll come back and we'll talk about some charts and we'll talk about what should happen on Sunday and Monday in the real-time markets. So again, what I'm about to show you doesn't seem to matter while we're going up. Everyone's so happy. 401k's doing great. My house is going up in value. I don't need a guy like Oscar. I don't care about any of the stuff that helps on the downside, right? That's how everybody is now. If it starts to go down, what I'm about to show you is a severe flaw in our trading environment. It is absolute. I know what I'm telling you. Watch this clip. You'll see why. Traders, an illustration. Follow me if you will. This is our friendly dynamic duo, Chris Dodd and Barney Frank. You guys, in your divine wisdom, trying to do the right thing, are basically going to destroy what we know as the QE saved markets of today. Let me see if I can explain. Guys, I'd like to thank you for trying to help us, but I assure you, you should have checked with us traders before you made rash decisions, and here's why. Traders, you are looking at a bird's eye view of a trading pit. I understand that markets don't look this way anymore, but this is a great example. Here is a trading pit. On the outside, all the orders come in from around the world. On the inside creates the liquidity, the bankers and brokers, the market makers that take the bids and offers from all these guys. But let's look forward. I recognize that today this is what we actually have. A pit would look more like this, and this is trading today. I get that. But the illustration, I think, is important, so let's go back to this. Dodd-Frank did something really, really crazy. This is where all the orders come in from customers all around the world. The brokers who stood up here, same thing as the brokers that are typing electronically. They get all the orders from everybody else, or the orders get sent in electronically. In here were all the market makers from Goldman Sachs and Morgan Stanley and everybody else that you could think of. They were all in here, and if anyone came in and said, where's a bid and offer on anything, someone over here said, 5 bid at 6, and he was able to trade. That's called liquidity. He gets an order, someone over here screams, he's able to trade. Plenty of liquidity. So even on the electronic markets, visualize that this is all the traders. Now, what Dodd-Frank did was they stated all of these cats in the middle can no longer use customer funds, and they're not allowed to create liquidity by making bids and offers. And what's happening now is just the brokers around the edge that have all the customer orders are fighting with each other. So you had a pit that looked like this, and here is what you did to it. You took the meat of the pit out. Now all these people basically have to do this with one another. The core is missing. This is what guys on the floor look like now. If there was a trading floor, remember this is electronic, but a great visual. And here's the result. Look at this guy. He's choking this guy right here. Look at him. He's choking him because they're all trying to do the same thing. Sell it to nobody because Dodd-Frank took the liquidity out of our markets. Do you see the visual? Traders, if you ask me, this all leads to one thing. Game over to our QE pumped up markets if they don't at least allow bankers and brokers to come back in and create liquidity. Okay, traders, you've seen that clip, right? Now here's the exciting thing about this. I kid you not, they have reversed or are reversing that entire video. The core or liquidity is coming back. What am I getting at? Give me that newspaper, baby. Check this out. This weekend, this Sunday, right? The weekend's Wall Street Journal, page B12. You got to look up this article. It means way more than you might think. Why is it buried on B12? I don't know. But listen to this. Oh, I'm so excited. The Volcker update will be a win for banks, right? Here's your article. Let me read some of this to you. Washington, an update to the Volcker Rule expected next week will deliver a victory to large banks that have fought regulators' efforts to clarify trading definitions, said people familiar with the matter. Skip. Let's move on down to here. As part of a broader review and rollback of the financial rulebook, regulators, led by the Fed last year, tried to clarify a provision of this rule long reviled by the industry, and now they are going to clarify the rule. In fact, they're going to rescind it. Check this out. In the final rule, regulators will drop the original provision restricting short-term trades from big banks, according to these people. Next, the regulators are also set to approve changes making it easier for banks to invest in hedge funds or private equity funds to underwrite securities or trade them on the behalf of clients. Now, here's where it gets crazy. You want to know what the rollback was? Listen to this. What they're going to roll back of this rule? Here is why. Traders, if you remember, before I finish this article, back in 2012-13, OMNI went on a 2-month losing streak. And I've never seen that happen ever. I've been working with OMNI since I'm a kid. So I also recognize the core of the market or the fundamental market itself has never been changed by any rules or any precedents or anything that's been either enacted or pulled away as far as rules are concerned since I started in 1982. I've never seen a fundamental change to the marketplace until Dodd-Frank came into effect around 2013, 2012. And the Dodd-Frank rule basically stated banks, brokers could no longer trade markets unless it was to get a client out of a position to create liquidity for the clients only, which removed the core from the markets. I mean, literally did. You've seen the videos. Now let me read this little blurb to you here. As part of a broader review and rollback of the financial rulebook, regulators led by the Fed are going to clarify the rule. But here's the rule that made me say, wow. Regulators sought, well, here it is. The intent prong generally restricts banks from holding a trading position for less than 60 days unless they can prove they did not intend to make a profit from the short-term trade. Banks have been dealing with this since Dodd-Frank. You cannot put on a position unless you prove you're trying to lose with that position. Who the hell would put it on? Now, why banks immediately pulled back on liquidity, the rule came out in 2008. It didn't get enacted until 2012. However, the rule of no trading, no creating liquidity. However, banks recognized in 2008 if we trade till 2012 and if they retroactively fine us for all those trades, what will that cost? So immediately in 2008 and 9, banks stopped making liquidity. They backed off on liquidity. And you don't notice it when markets are going up. But God forbid we end up in a bear market. Let me tell you something right now. Without the core in this market, it would just plummet. You've seen the videos. I've shown you the reasons why this would happen. I've done many other videos about the non-liquidity in the past. Well, this video is about liquidity coming back. Thank the Lord. And you know what? I think the banks are taking to it already. The market has already started to take off. And that brings me to this video for trading on Tuesday. Traders, as we know, futures trading, stock trading, every type of trading you can think of is extremely risky. I've said it in the earlier video. I'm saying it now. It is very, very risky. You've got to put your stops in. You've got to put them in first. Never trade without stops, ever. And never trade without money earmarked to be lost just in case things go bad. Now, video number 1981 for August 20th on the board says the call or liquidity is coming back. We just talked about that. You've seen the video. Markets, like the stock market, tends to rebound after a tariff round is announced if the market gets back above the OMNI average. Let me show you that in this video. I think you are going to love the charts that you are about to see. If you do like what's in these videos, if you like the way I present myself, if you think I can help you via technical analysis, please subscribe to my videos, like them, share them, follow us on the internet. Anything that you can do to spread these videos around would really help my cause, and I'd much appreciate that from you. Please like, share, and comment on these videos. With no further ado, let's go look at some charts. Okay, traders, you have seen this chart in many other videos, but we're going to go over it again because it's extremely important to what's going on right now. So, this is the Dow Jones Industrial Average weekly chart. Each one of these lines here represents a full week's worth of trading. When Trump announced the first round of tariffs on China back in Jan 2018, we cracked 3,200 points, had our recovery, went to what's called the double top, no tariff announcement here, and we cracked. Tariff announcement drops 3,300 points. Double top creates some market tailwind, or headwind I should say. Market comes down, but this wasn't a tariff, right? This was a double top reaction. Second round of tariffs gets announced. May 2019, and we cracked 2,009 points, right? Just about 2,000 points, a little bit over. First crack, 3,300. Second crack, 2,009. Then we rebound, we make new highs, we get another round of tariffs, July, August 2019, just recently, and we crack again, but only 1,942 points. What's my point here? Each time we get a round of tariffs, we crack less, and more importantly, once you get to the OMNI average and you hold, you start to explode again. Even when you got under it, once you got above it, you exploded. Here you held it. Once you stayed above, you exploded. Here we just held it last week. Literally just held it right up till Friday last week. So here's your weekly Dow telling us that you're not supposed to drop much further because the tariffs seem to be less impact each time, plus this tariff came with a lowering of the interest rate, which is absolutely something to help markets, right? So this drop should be less. It gets right to my OMNI average and holds. Last time, same thing. Time before was not a tariff, right? That was just a double top reaction. So let's take this a little further. Let's now look at the NASDAQ on a weekly, with the exception of once, and that was the double top. That had nothing to do with a tariff round. Market holds the OMNI, runs up, market holds the OMNI, major run up, market breaks the OMNI, but once it gets above, see what it does? Holds the OMNI, new highs, hit the OMNI, and it's already holding. That's your weekly NASDAQ, top day as of right now. There's your weekly E-mini S&P. What do you see? Exactly the same thing happening. And we've held, and we're all the way up here right now. This is where we reside as a market right now. Bounced off this thing last week and started to rally back up. So my OMNI average is proving to hold as it normally does. Now we're going to take this down to the daily. What about trading top day, today, tomorrow, right? Monday, Tuesday. Well, let's look at this. Tariffs get announced, we crack. Get to the 200 bar moving average. Here's where it gets important. Once you get above the 200 and back above the OMNI, explosion. Here, we just got under the 200. Now we are back above the OMNI as of this recording. If we settle above the OMNI, I say the explosion takes place. Now, is this a big bear flag? Sure, could be. But let's go with the bigger things. A flag is a smaller formation, if you will, expected to last less time than something major like averages and market trends. The averages tell us once you break the 200 and get back above OMNI, watch for the upside. You broke the 200, and we are now, as of this recording, back above Omni. Let's look at the NASDAQ on a daily. Same exact thing happens. You break the 200. Once you get above it and get above Omni, massive rally. We break the 200, get back above it. Now we are above Omni and pretty strongly above Omni. Omni's here. We're here. Pretty strong, right? You got to think, unless I get a sell signal from Omni, we'll just keep buying this. We'll get, we'll watch out at the top of the flag there, but we'll just keep buying dips. Let's see what else we got. Look at the Dow Jones Transportation Average. This has been the leader on the downside. It has put in what people call a double bottom. I'm no big fan of double bottoms due to market gravity. But if they do hold, I'll acknowledge. So the double bottom did hold, and we're here now off that double bottom. So the leader on the downside of this whole move has been the transportation average, and it has found a place to find support. So if you ask me, unless something goes wrong or I get an Omni sell signal, we are back in buy mode. We'll take this one day at a time, but I thought that was important to show you, traders. We may actually get above these flags and take off this week. One day at a time. We'll find out together at livewithoscar.com. Traders, you've seen the charts, and let me just say thank you, SEC, CFTC, the Fed, FINRA, and Donald Trump's administration. Thank you for paying attention to the liquidity rules. I've been yelling about this for the last few years. I feel so much better now. If we go into a bear market, at least it'll have some kind of order to it compared to what we would have gotten without the liquidity. So again, thank you. Now, OmniX. I have an Omni camp coming up. There are only 2 seats. You better come out. There's a month left. 2 of you need to contact me immediately. Let's get started before we miss our chance to get your tickets and get yourselves out here. Omni camp starts September 19th. I will teach you the art of Oscar's market navigational indicator, the Omni. You want to learn how to call these Omni trades for yourselves? I'll teach that to you right here in Las Vegas. All you got to do is act now. Call me, 702-629-4755, or shoot me an email. Come to livewithoscar.com. There's 1,000 ways to find me. I'm on Facebook, I'm on Twitter, I'm on YouTube, I'm on everything out there. If you want to make it to this year's Omni Camp, last one this year, traders, I'll tell you right now, the price next year doubles. We're going to $15,000 a seat next year. It's $7,500 now. You want that? Come on down with that. I give you free lodging. The food is on us. The transportation, except for your airfare, is on us. And you will leave with a brand new laptop program by me personally with the Omni. We completely encompass you with everything that you will need at this Omni camp. But you've got to come out. I can't do this for you unless you come out. Call me, 702-629-4755. Don't miss your chance. There's only 4 weeks left this September's Omni camp. Traders, that's about it. I'm getting out of here. I want to go back down into the office and see where these markets are. It looks to me like banks are already starting to create the liquidity because we're starting to move up pretty rapidly. Just see what's going on out there today. So I want to get back down in there. Traders, keep your emotions out of trading. One of the best things you can do to help keep those emotions at bay, and I know that's not going to be easy, but try this. Say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Once again, thank you, regulators, for coming to your senses and fixing this liquidity problem. Past performance is not indicative of future results. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.